First of all, let me be clear. As we think about listed REITs are a leading indicator in both downturns and recoveries. And I lead with that because listed REITs have had a challenging past couple years. Global REITs are down around 18% from their peak, and European REITs are down around 30% from their peaks. But we think we're on stronger footing now. We've long argued that recessions create attractive entry points, and when global central banks stop easing or stop hiking interest rates, then it's a better backdrop for listed REITs. And that's actually what we're seeing playing out. Over the past 2 months, believe it or not, global listed REITs have rebounded around 21%, and European REITs are up around 30% or so. And just to put an underscore on this, November was the 3rd best month ever for European listed REITs. It was the 5th best month ever for U.S. listed REITs. So we do think the worst is behind us, but that doesn't necessarily mean that the private markets are on stronger footing yet, because we think they're still in the early innings of their declines. European valuations are down around 10% or so. U.S. valuations are down around 13% or so. And we think they're about 50% of the way through their correction.
Okay.
So we're really seeing a disconnect.
Yeah, it's really interesting to hear what you're saying about the correction is only about half of the way through in terms of actual asset values. But in terms of REITs performance, of course, we did see that big bounce in November. But my question to you is just how much of that is a reflection of global market sentiments and the fact that markets, we've been talking about it for the better part of this show, interest rate expectations, the markets are getting ahead of themselves in terms of what they expect out of central bank policy for next year. All of that is good for a beaten down sector like the real estate sector. So how much of this is simply just market rotation as opposed to people buying into the fundamental thesis of REITs at this point?
Yeah, it's a really good question. And I think both of them deserve a little bit of an explanation here. To be clear, listed REITs globally have had a big challenge because we were dealing with a stagflationary environment where interest rates were rising and growth was slowing. We think that's behind us now, or moving into more of maybe a stagnationary environment. So if in fact interest rates will continue to fall, that's good for listed REITs. I do think that the listed REIT market is pricing in more of a soft landing. But you bring up another really good point that I think deserves some explanation. You are absolutely right. Sentiment is poor on listed REITs. Generalist investors have been underweight the sector. Hedge funds have been short the sector. So what we're seeing right now is a rotation because of fundamental reasons. We see generalist investors beginning to cover their underweights, and that's leading to short covering in the hedge fund community, while there is some buying from the long-only community. So all of this is leading to a pretty significant rally over the past 2 months or so.
The other thing that happened in 2023 is because of the general environment, because of the funding environment, higher interest rates, the pullback that we've seen in commercial real estate properties, many property companies have had high-profile bankruptcies or have just come under a lot of scrutiny, especially over here in Europe. We've been following closely the likes of Cigna, and that is a whole story in itself because of various reasons. But ultimately, what has happened the past year is if you were on shaky fundamentals, then the macro environment really exposed a lot of the problems that many of these property developers were facing. So to your mind, are there still going to be areas of the market that will come to surface in 2024, given that we still haven't fully felt the impact of the existing rate hikes to the economy?
Yeah, absolutely. So we think that this first 50% of decline in commercial real estate prices is really driven by the higher interest rate environment. But the next 50% of declines, that's going to get us down to like 20 to 30% declines in property valuations, is really going to be driven by increasing default. So we actually haven't seen the rubber meet the road yet. And look, the headlines are going to be challenging in 2024. But I think there's an important point here about the listed REIT market compared to the private markets. The listed REIT markets are actually on pretty strong footing for a number of different reasons. First and foremost, their balance sheets are pretty strong. In the United States, listed REITs have loan to values less than 35%. In continental Europe, that's less than 40%. So that's a much stronger footing than what you see for the broader commercial real estate market. The second point is that office, which gets a lot of media attention, is a very small portion of the listed REIT market. In the United States, it's around 3%. Globally, it's around 7%. So there's some headlines that are maybe creating some misconceptions about listed REITs compared to the broader market. And frankly, listed REITs have been a net sellers of assets since 2015, while the broader market has been net acquirers. So we think that the outlook for listed REITs is actually much better, even as 2024 might bring some headlines for the broader commercial real estate market.
Well,